A lower inflation number does not lower the rent that your tenant already pays. It does not lower the price your customer already absorbed, and it does not lower the rate on the loan that you are underwriting today. So hold on to that thought for a moment because there is a change coming to the way inflation gets measured, and it is going to tempt a lot of people into the wrong conclusion. But before we dive in, for those who may be tuning in for the first time, my name is Vessi Kapulian. I spent the majority of my career in underwriting and risk management, heading a north of $1 billion credit portfolio. I'm also an investor, specifically real estate investor, and today where I spend the majority of my time is working with founder-led enterprises and their family offices at the board level, advising on risk management, strategic investments, governance, capital allocation. So today's topic it was really inspired by an article that I came across. It didn't quite make a lot of headlines, which is why I want to talk about it today. And so let me first set it up. The Bureau of Economic Analysis is, according to that article, is preparing to change how it calculates certain prices inside PCE. And this is the PCE is the inflation gauge that the Federal Reserve watches more closely. Before I dive into the article and the implications it has on the investment landscape, I want to take just a step back, especially for those of you who may not be tracking this as closely, and clarify a couple of points when it comes to inflation. You're probably hearing often about PC, but also about CPI. So you may wonder what's the difference and why the Fed watches PCE more closely versus CPI, but CPI is also making the headlines, and I know this can be confusing. It was confusing for me when I first started tracking economics and macroecon indicators. So the CPI stands for the Consumer Price Index. It is actually published monthly by the Bureau of Labor Statistics, and it is based on effectively the urban household surveys that are tracking direct out of pocket spending. It is a little bit narrower in scope. It measures out of pocket expenditures by urban consumers, and housing carries a very heavy index in that, a very heavy weight in that index. Now, the PCE, or the Personal Consumption Expenditure Index, that's compiled by the Bureau of Economic Analysis, or BEA, and it's based on business surveys as well as the GDP, or gross domestic product. It is a little bit broader in scope. It includes both urban and rural spending, plus indirect costs paid on behalf of consumers, such as, for example, health insurance, Medicare, Medicaid are just a couple of examples that come to mind. And so the difference between the two really boils down to the substitution effect. The PCE updates the item weights quarterly and accounts for the consumer shifting to perhaps a cheaper alternatives when prices rise, hence the substitution effect, whereas CPI updates less frequently. And over the long run, CPI generally, again, that can vary, but generally it runs about 30 to 50 basis points higher than the PCE inflation. And so why the substitution effect matters is because when certain product spice, shoppers may want to less expensive but similar alternatives. Maybe you're buying branded cheese at the grocery store, and now you switch to private label. That would be like one example. It also treats the spending habits. The CPI treats the spending habits as fixed for a longer period, assuming you keep buying the same expensive item, which is not necessarily true, whereas the PC index updates those quarterly, really capturing some of those shifting trends. And so Because of that, the Fed watches the PC more closely, thinking that maybe CPI may overstate inflation by missing what the actual spending patterns are. And also because it's broader in scope, again, capturing both urban and rural households. And so um, when they state their 2% inflation goal, the Fed is usually referring to the core PCE index. So I thought I would make that distinction because the article specifically focused on the PCE. And so another comment I want to make is that, by the way, these revisions are not at all uncommon. They have happened in the past, and actually they're published on the main website, so you can see how the index and its calculations have evolved over time. If you are wanting to see what inflation would truly look like without any of those different adjustments over time, adjustments that have taken place over a number of years, there is another site. I'm not sure they picked the best name for it, but it's actually a good resource, Shadow Stats, and I can put the link in the comments. Just tap reply and let me know. Happy to provide you with the link. But there you can see what true inflation is today, absent any of those historical adjustments that have taken place. So according to the article, so going back to the article that I mentioned at the beginning, those revisions are expected to actually lower the core PCE, the version that effectively strips out food and energy, by roughly 20 basis points, with the first update landing around September. Again, not many headlines are talking about it, but I'm sure that when inflation shows some relief later in this year, that will definitely make for a lot of headlines. And some economists say that that alone could also give the Fed a little bit more room to hold rates steady rather than raise them. Again, the primary concern, as stated currently by the Fed, has been inflation. And some critics also say that the categories being reworked happen to be among the biggest contributors to inflation, which then raises a fair question about whether it is a better measurement or if it's really done for optics. I'm not necessarily here to settle that debate, but I do think it's important to note that distinction. And specifically, what I want to talk about is what it means for investors as they evaluate deals, because this is the part that often gets lost. And remeasuring the gauge, right, the KPI, doesn't necessarily change reality, right? If a set of prices reset higher over a period of time, changing the formula does not necessarily walk these prices back. Your tenants will still pay the rent they pay, and if anything, it will probably go up, subject to local supply and demand dynamics. Your customers still pay what they pay. The grocery store is not automatically going to drop prices back to the levels they were at. Housing is not going to drop prices back to the levels they were at. The price has already reset, and that reality does not change just because a spreadsheet at the Bureau of Economic Analysis got rewritten, just because a methodology got changed. So the first item or point to take away with you is simple. The number on the screen and the number your clients wallets are dealing with in real time are two different things, and you have to underwrite their ability to spend, their ability to afford a home. Now, the second layer, the second point, and this is where it touches your cost of capital. As long as prices stay elevated, that keeps the pressure on rates, especially long-term rates, which is what drives a lot of the lending rates, right? The 5, 7, 10 year, and it makes it harder for them to fall fast or or at least as far down as people want or hope they would. Could rates come down? Yeah, of course they could. Could they stay where they are? Sure, they could do that too. I'm not going to stand here and try to make a prediction or tell you which way rates will go. I don't think anyone is in a position to do that or really control that, and I'm not going to pretend otherwise. That's usually how people get hurt. But that uncertainty is the whole point I want to make, that if your deal only works because you hope that the rate improves, then you have not really underwritten the deal. You have underwritten a forecast that may or may not occur, and also it's somebody else's forecast, not something that you control. So let me ask the question that I ask on every deal that I look at. What is the hidden cost if assumptions go wrong? What breaks this deal? Say you buy at today's price on today's loan terms, and you're counting on a lower rate when you refinance or when the rate cap expires, when the loan expires. If that lower rate does not arrive, what happens then? The debt service still stays high, the coverage tightens, the refinance you assume would carry you either does not happen or happens on terms that effectively eat your equity. And if you're looking at an exit, not a refinance, you're facing very similar circumstances, because the buyer of the property, right, would be going through those same issues that they're looking to resolve. And this is not a small miss, right? That is the difference between a deal that survives a hard year and the deal that hands back the keys. And we're seeing that in real time today. And again, notice that none of it required a crash, right? Like the Great Recession. It only required in this particular example for the rates to not cooperate relative to your original forecast. So this is how I would take that information and carry it into the model or any deals that I'm evaluating today. Underwrite the deal to survive today's cost of debt or higher, not the rate that you hope you can refinance into. The rating that's in front of you today, or a version that is worse. Again, prepare for the worst, hope for the best. And if the deal still works underwritten that way, you have a very strong deal, all else equal. If a lower rate shows up later, great. I will treat it as a bonus, but not the line that the whole deal hinges on. Again, this is the prepare for the worst, hope for the best, and not predict posture. And Howard Marks has actually written about it for years. You cannot forecast the macro reliability, but you can build something that survives being wrong. And that's the whole idea. You're not trying to call the rate, but you're trying to be fine and protect the downside either way. And this is not only a real estate discipline. If you're acquiring a business with leverage, that same logic holds. The cost of your debt is impacted by similar forces, and the prices your customers pay or the business customers pays, the wages it pays, the inputs it buys, those stay reset too. They don't necessarily go down. And so underwrite the acquisition to service its debt at today's rate on margins that do not assume the customer suddenly has more room than they do. And then one more piece I want to make before I go is, because the reset reality shows up twice in a deal, and it's easy to stress only one side. On the debt side, you stress the rate. I spoke about that a moment ago. On the demand side, you stress the customer, or if you're into the apartment business, right, your tenants. A tenant whose groceries, insurance, utilities all reset higher, and they have already, has less room to absorb the rent increase, has less room to absorb additional fees. And again, we're seeing that real time today. Granted, in some markets, it's not only impacted by inflation, but also by supply and demand dynamics. And or a portfolio company selling to a stretched consumer has less room, right, to push the price. So when you model rent growth or revenue growth, respect that the wallet already absorbed 3 or 4 years of higher prices, and it's running thinner than it was in the past. Yes, wages have gone up, but not necessarily at the pace of inflation. And the room for error on the demand side is real, and it is easy to underwrite it away, but you shouldn't, right? And we're seeing that in real time in many markets, with delinquencies, concessions rising, and a lot of apartments hitting that affordability threshold. So I will leave you with the question to think about, and not necessarily the answer, but look at a deal that you're evaluating right now. Does it survive the rate if it never improves, or if the consumer or tenant never gets more financially comfortable than they are today? And if it does, you're probably in a good place, all else equal. But if the only way the deal works is a rate cut, or you have effectively underwritten hope, or as I like to call it, hopium, and you're calling it a deal. The inflation number may change in September. We shall see how things pan along after that revision. At that point, the inflation itself may move the number. I am not quite sure if people will talk about the change in methodologies, but it will not change the rent your tenant pays, or the rate on your loan. So underwrite the reality and let the relief, if it comes, be the cherry on top, or the bonus. So if you'd like a second set of eyes on a deal that you're weighing through this lens, or real estate or an acquisition, connect with me and we'll walk through it together. I do these second set of eyes deal reviews for many clients. And as far as the pop-up live events, I hop in Thursday, sometimes Friday afternoons weekly, where I share my thoughts on the markets, due diligence, deal analysis, and if you'd like to be notified of those, tap subscribe under LinkedIn, YouTube, or Facebook, where I stream live. So that's the live, and I will see you on the next one.